everyone, welcome to the 5th episode of our Contra investing series where we discuss companies that are fundamentally strong but have corrected a lot. In today's video, we'll discuss KPIT Technology, one of India's most well-known auto tech companies and a big beneficiary of global shift towards electric, connected and autonomous vehicles. I remember discussing it for the first time way back in 2022 and has been a huge wealth creator for its investor, driven by strong deal wins, rising EV spending and massive tailwind in automotive software. However, its stock price has corrected around 35% in last 18 months. So many retail investors are confused. Is KPIT growth story over? Is EV hype cooling down? Is KPIT still a good company or is something fundamentally wrong? As usual, we'll put KPIT in our 4-point contra investing framework and identify if it is a contra opportunity or not. Alright, let's get started. So first of all, we'll look at, is the business fundamentally strong or not? Where we'll cover business model, management quality and balance sheet. Now before we talk about KPIT business, let's first understand what problem they are trying to solve. So today's cars are no longer mechanical machine. They are softwares on wheel. Every modern car has hundreds of sensors, dozens of ECUs, that is electronic control unit, advanced ADAS system, autonomous driving algorithm, vehicle connectivity, infotainment platform, battery management system, over-the-air software updates and so on. Basically, the amount of software inside a car has exploded. This is where KPIT comes in. They build critical automotive softwares in areas like autonomous driving, electric powertrain and battery management, ADAS and safety system, connected vehicle platform and middleware and software integration. In simple words, KPIT helped global car makers build the brain of modern vehicle. The best part is, autonomous software development has extremely high entry barrier. A single algorithm failure can risk human life. That's why companies work with partners they can trust. This creates long contracts, 5 to 10 years, deep integration and very low churn and massive stickiness. So once KPIT goes inside a vehicle program, they remain embedded for years through concept, design, validation, SOP and post-launch support. KPIT also has strong visibility due to multi-year order book, usually linked to entire vehicle platforms. And unlike generic IT services, KPIT work on platform-based engineering-led projects, not the low-end IT work. This makes KPIT one of the purest play on EV autonomous software-defined vehicles. That's their core USP. As far as management quality is concerned, KPIT was founded by Ravi Pandit and Kishore Patil, both extremely respected persons in Indian IT engineering space. In my opinion, KPIT management is extremely domain focused. They doubled down on automotive long before EV autonomous became a global trend. Also, they have done a very strategic capital allocation. They restructured the company into a pure play auto tech firm by hiving off unrelated businesses. And KPIT leadership has clear long-term vision. They repeatedly emphasize on software-defined vehicles as a decade-long mega trend. Promoter holding is stable in the company, governance track record is clean, and leadership is deeply involved in product and engineering. Then if you look at the balance sheet, KPIT has one of the cleanest balance sheet in the mid-cap IT space. Virtually debt-free, strong cash generation, extraordinary ROC and ROE with a solid margin profile. This shows their business strength and competitive positioning. Overall, KPIT's fundamentals are strong. It's niche, sticky, high entry barrier and aligned to a global mega trend. Now let's move on to the second and most critical question. So second question on contra valuation is, are the current issues temporary or permanent? So if you look at KPIT earning growth trajectory, both its revenue and profits have grown at an exponential rate between 2021 to 25. While revenue compounded at 22% and 34% CAGR respectively in 5 and 3 years, profit compounded at 40% and 44% CAGR respectively. As a result, its stock price jumped 40 to 50 times from COVID lows. However, in trailing 12 months, its revenue growth has dropped to 13% and net profit growth has dropped to 6%. Due to this sharp fall in earning growth, coupled with high valuation, its stock price has tanked around 35%. Now the question is, what factors resulted in slowdown in earning growth for KPIT? So the slowdown in KPIT earning growth is largely driven by two external factors. First is geopolitical issues. Especially the US-China tariff war and Europe's weak macro environment have disrupted the EV economics globally. OEMs are reworking supply chain, delaying new EV launches and pushing out large software engineering programs, which slows the deal ramp up for partners like KPIT. Also, please note that Europe is the largest market for KPIT with around 47.7% revenue contribution in FY25, followed with US with 27.7% contribution and rest of the world has 24.9% contribution. So nearly 75% of KPIT business comes from US and Europe. Then second reason for slowdown in earning growth is intense Chinese competition that has triggered a severe price war in the EV market. Companies like BYD are exporting aggressively into Europe, putting massive pressure on Western OEM margins. When profitability gets squeezed, automakers pause or defer the high-cost projects such as next-gen EV platform, ADAS, and autonomous feature, all of which are KPIT's core work stream. So the issue is not loss of client, but client-side delays due to geopolitical and competitive pressure, which is temporarily impacting KPIT's revenue momentum. Now, this is something you only know when you closely track companies' quarterly result and read the con call. Although I understand that for a person with a job or business, it is very difficult to track so many things. That's where I have a weekly video series for serious investors where I keep a close eye on nearly 200 companies and identify investment opportunities. I also share my own investment thesis for buy and sell. But again, the idea is not to give buy-sell call. The idea is to help you build the right thought process with the right information and accordingly build the portfolio. Now let's look at the third criteria. Despite the near-term slowdown, the long-term demand story for KPIT remains exceptionally strong. Global automakers are in the middle of biggest technology transition in last 100 years, shifting from mechanical vehicle to software-defined, electric, connected and autonomous architectures. This shift is irreversible. Every OEM, whether in the US, Europe, Japan or India, they need to modernize vehicle software stack, consolidate more than 100 ECUs into centralized compute, build the advanced ADAS or autonomous feature, develop battery management system and roll out over-the-air update platforms. Even with temporary delays, automakers cannot afford to stop these programs because vehicle launches are planned 4 to 6 years ahead. The complexity of software in car is doubling every few years. The share of software cost per vehicle is rising sharply and regulatory pressure is increasing globally. KPIT sits right in the middle of these long-term themes. SDV, that is software-defined vehicle, EV powertrain, ADAS, AutoSAR, middleware, digital cockpit and cloud-connected platforms. KPIT today works with more than 25 global OEMs. Companies deeply embedded in their long-term roadmaps and most of its projects span 5 to 10 years. Here please note that EV penetration may slow down cyclically, but the direction is irreversible. Even hybrid models need massive software upgrades. Autonomous vehicles may get delayed, but every car is moving towards partial autonomy, which still needs the ADAS, sensors and AI software. So while short-term spending may fluctuate, the structural multi-year demand for automotive software engineering remains very strong. Recently, company's management has mentioned that we are confident of better H2 and a promising FY27. Now let's look at the fourth criteria. Now fourth criteria is, has valuation reset? So KPIT correction was primarily a valuation reset. The stock had run up sharply over the last 2-3 years, even touching 70 to 80 times PE at its peak. At those valuations, the market was pricing in flawless execution, uninterrupted EV spending and a sustained 25 to 30% kind of growth trajectory. So the moment growth slowed, even temporarily, the premium collapsed. On top of that, geopolitical worries, rising Chinese competition and delays in large deal ramp-ups further pushed the investors from growth at any price to show me earning more. As a result, the valuations have cooled off meaningfully. KPIT now trades in the PE range of 40 to 45, which is still not cheap, but much more reasonable for a niche ER&D leader with strong visibility, long-term client stickiness, and a structural industry tailwind. This valuation reset also brings expectation back to realistic level, meaning future execution will again start getting rewarded. This stock is no longer priced for perfection, which reduces the downside risk and creates a healthier base for long-term investor. That said, everything will depend on the growth trajectory. If KPIT manages to return to its 25 to 30% growth zone, the stock can re-rate from here. But if growth settles at let's say 15-20%, a re-rating is unlikely. Although the stock can still deliver steady compounding returns. Now if you look at institutional holding, FI increased their stake between December 22 till 23. However, since then they are consistently reducing stake. Although the stake sale is completely absorbed by domestic institution. Net-net, public holding has remained at similar levels. So on one side, foreign institutions are selling stake, domestic institutions are increasing stake. This suggests a mixed reaction. I would like to keep a close eye on institutional buying. Technically, stock is in downtrend, trading below its 200-day moving average, and 50-day moving average is trading below its 200-day moving average. Overall, if we conclude, fundamentally KPIT remains a very strong business. Niche, high entry barrier, deeply embedded with global OEMs and sitting right at the heart of the software-defined vehicle megatrend. Nothing is broken in the core business. The slowdown is real, but it is cyclical, not structural. Geopolitical uncertainties, the US-China tariff war, Europe's EV profitability issue, and aggressive Chinese competition have forced OEM to delay or phase out large EV and autonomous program. These are external disruption, not KPIT specific problem. Once the macro stabilizes, these programs will eventually resume because OEMs simply cannot delay software for too long. On the long-term story, it remains intact. The shift towards electric, connected and autonomous vehicle is not going backwards. Software complexity per vehicle is rising, OEMs are outsourcing more than ever, and KPIT is one of the best positioned players in the world to benefit from this decade-long transition. Valuations have also cooled off meaningfully. The stock is no longer priced for perfection, which brings downside risk under control. But future returns will depend entirely on whether KPIT can get back to its 20-25% kind of growth zone or not. If growth rebound, stock can re-rate again. But if growth stays at 15-18%, returns will be more moderate, steady but not spectacular. So is it a counter bet? Yes, but only for investors who believe in the long-term EV or software-defined vehicle story and can handle near-term volatility. The only catch is valuations are still not cheap to generate multi-bag return from here. Still, I believe KPIT is a good SIP grade company that has a compounding potential for long term. Now you tell me in the comment, is KPIT a counter bet for long term or not? And is it worth adding after 35% correction, or do you find the valuation still high? Thank you for watching this video. I'll see you next video. Till then, take care.